Hello everyone, I'm Paige White, and today we're going to briefly be discussing the taxable year of the partnership. So to start off with, a partnership has to have a required tax year as its accounting period, or it can use one of the three allowable alternative tax year-ends, which we will discuss in just a minute. So taxable income flows through to each partner at the end of the partnership's taxable year, and then a partner's taxable income includes the distributive share of partnership income for any partnership taxable year that ends during the partner's tax year. So you can see here that wording is very important. That's why it's italicized, so you can distinguish between partner and partnership, just to make it a little bit more clear. So the required taxable year rule, it prevents excessive deferral of taxation of partnership income. So here's an example of how a deferral might arise. So in this example, if a partnership's adopted year ended on January 31st, the reporting of income from the partnership and payment of related taxes would be deferred for up to 11 months. So for instance, income earned by the partnership in February 2017 would not be taxable to the partners until the partnership's tax year closes on January 31st, 2018. It would be reported in the partner's tax returns for the year ended December 31st, 2018, and so then it's not due until April 15th, 2019. So even though each of these partners would be required to make quarterly estimated tax payments, some deferral might still be possible. So next we're going to talk about how to actually determine the required tax year. So there's three different rules that are evaluated, and you have to go in order. So for the first one, the partnership uses the tax year of the majority partners if partners owning more than 50% of partnership capital and profits have the same tax year. And then if they do not meet that rule, you go on to the second one, which says that the partnership uses the tax year of the principal partners if all partners who own 5% or more of capital or profits have the same tax year. And then if no partner who owns a 5% capital or profits interest, there aren't any, you go on to the third rule, which states that the partnership determines the year under the least aggregate deferral rule as outlined in the regulations for 706, so you can go and look that up. But you have to go in order on these rules, so if it doesn't meet the first rule, you go on to the second. If it doesn't meet the second, you go on to the third. And that's how you determine the taxable year. But there are also alternative tax year that are available if the required tax year is not desirable for the company. So the first option is to establish that there's a specific business purpose that exists for a different tax year. So this has to meet the IRS's satisfaction for you to use this option. And then the second option is to elect a tax year so that taxes on partnership income are deferred for not more than 3 months from the required tax year. So this option is very restrictive and it can be expensive, so it's not usually picked. And then the third option is to elect a 52 to 53 weeks taxable year that ends the same week as the required taxable year. So they can use any of these alternative methods if the required one is not to their liking. So we're going to look at an example now. So Cerulean Inc., Coral Inc., and Crimson Inc. formed the 3Cs partnership on January 1st of the current year. Cerulean is a 51% partner, and Crimson and Coral are 25% partners. For reporting purposes, Crimson uses October 31st year, and Coral uses the calendar year, and Cerulean uses February 28, 29 year end. So in general terms, how is the required taxable year determined? So there's no calculations required. We're just going to go back to these three rules here, and you're going to start with the first one and see if it meets that requirement. So this one is the majority partners, so if anyone owns more than 51%, then you're going to have that same tax year. So we can see on this one, Cerulean is a majority partner, so we're going to go with that year end, which is the February 28, 29 year end. Now if it hadn't met that rule, we would have gone on to the second or third to determine what the tax year should be. But that's basically how you figure out the required taxable year of a partnership. But you can go in more depth in the textbook if you want to. And please let me know if you have any questions or comments. And be sure to read this chapter to get more detail. Thank you so much.